everyone, Ben Nelson here, the Everyday Real Estate Investor. Thanks for tuning in to another episode of the podcast. Really appreciate it. And hope you're finding inspiration from these episodes. Hope you're finding these helpful, the people that we talk to, that it's inspiring to hear other people and their stories, and hopefully you're learning some new things, what to look for, tools, tactics, tricks, all those things. And that's what we're going to talk about today as well. I'll get into that in a minute. But again, the premise of the show, I always bring it up every time because it's important to me that it's really easy to just have excuses, especially being busy. And there's a lot of people out there that maybe don't want to be full-time real estate investors, but they really want to be involved in real estate investing, but they just can't figure out how to do that and how to fit it in their lives. So that's really a big goal of this podcast, is how do we encourage each other to be involved in real estate, to not use being busy or having a family or a professional career or whatever else is keeping us busy during the day, to not use that as a reason to not be involved in real estate. There's ways to get involved and integrate that in your life. And again, maybe the goal is to be full-time at some point, but you got to get there somehow, right? You got to figure out how to do it. And so if you're always coming up with excuses, reasons why you can't do it, then you're never going to get there. So with that, we are going to talk. Actually, before I jump into that, I just again putting out there. So I am a real estate broker, and so I'm full-time in the real estate world, but I'm very busy in my brokerage activity. So that I have to balance that and my family, my wife and my 3 kids that I love very much, and I love spending time with them. And still trying to figure out and find time to invest and be strategic and find deals and things like that. It's a little bit different of a scenario, I understand, than someone that goes to punch a clock at an employer and that sort of thing. I do have a lot more flexibility. I am involved in real estate on a day-to-day basis, but I do still have things pulling me away, right? So, but being a real estate broker, I am absolutely looking. We're busy. I'm working with a colleague of mine, Anita Borges, on getting more in, focusing a lot more on helping other investors and multifamily and a lot of those things. So we just have a lot of irons in the fire. We have a lot of things going on, which is great, but we also need other people that we can work with. We're very collaborative. We believe in abundance, and we are looking for great brokers, experienced brokers, awesome. Newer brokers, that's fine. We're willing to teach and help you. Obviously, that's why I'm doing this, right? Is to teach people and help them learn. So we have no problem doing that, and just help people get into real estate, up their game, maybe branch out into some other areas, in the investment world if they're not currently involved in that, and just have some other agents on our team. So I'm just putting that out there. We're obviously here in the Portland, Oregon metro area. Portland, Salem, both those major markets, metro areas we work a lot in. But investing is all over the place, and I'm involved in other markets, and would love to connect with anybody that wants to be. I don't think we have to be located in the same spot to collaborate and be on the same team and be working towards a common goal. So if you are interested in being a part of our team and joining up and joining forces and collaborating and doing more in your business and learning and just sharpening iron, right, that sort of thing, I would love to talk to you about that. So feel free to reach out through the website, message me on through any of the social media platforms, anything like that, and let's start a conversation, see if it would be a fit to have you join and come on board. So with that, let's jump into, that was a way longer intro than I planned on having, so I apologize about that. But let's jump into the topic today. If you're watching the video on YouTube, you're going to see I'm going to look down at my notes a little bit more than usual today, because we're going to be talking through some specific numbers. So I just want to make sure that I'm referencing those. So, but we are going to be talking about quick metrics for initial analysis. And just kind of going along with our theme of being busy, so I've talked in the past about knowing what you're looking for, right? That's a shortcut by itself, because if you don't even know what you're looking for and what numbers work for you and what you're trying to accomplish, you're going to spin your wheels. You're going to look at tons of deals. You're never going to buy anything. Even if you do, you probably don't even know why you bought it. I mean, it's just, if you don't dial in on what you're looking for, you're going to waste a lot of time. That's the bottom line. So this is different, but this is a way that you can hopefully also shortcut some time and look at a lot of deals and kind of narrow down which ones to spend more time looking at and more time analyzing. So these are absolutely not an entire like due diligence on a property. These are starting points to get you down, like whittle down your list, right? Of you're looking at hundreds of properties. You need to look at lots of deals to find the good ones. But if you're spending, half an hour, 45 minutes, an hour more on every single one you're looking at, it's going to take you a lot longer to get to the good deals, right? So this paired with your own personal investment philosophy, again, stole that from the Real Estate Guys radio show, borrowed it, I guess. They say that all the time. That's why I was referenced them, because that's where I got that from. And that's a very important thing to me, because I think it's so many people miss that. And so they're the ones that put that out there to me first, and where I first heard it. And, I'd been going down the road of just like whatever works, wherever, not being strategic about it until I heard that. So anyway, starting there, what do I want? What do I want real estate investing to do with me? What are my risk tolerances? All of that stuff. And then from there, taking that into your analysis and being able to look at these metrics and things and do some quick analysis before you move on to the next step and say, is this worth looking at closer or not? Okay. First one that we're going to look at is price per unit, price per square foot. Okay, this is a pretty simple one, and there's only 3 of them, so they're pretty but there's are 3 big ones that'll help you narrow stuff down. So first one, like I said, price per unit, price per square foot. So this is a really easy one. The formula for this is basically just the price divided by the number of units, or the price divided by the total square footage, right? So you have a $2 million building. You have 10 units in that building. You have 900 square foot units. So the price per unit is $200,000 per unit, and the price per square foot is about $222 per square foot. So that's a really quick breakdown that you can look at. And as you're looking at lots of buildings, you'll start to see a pattern, right? You'll start to see what things are trading for. And you have to take obviously condition and location and all that stuff into it, but this will get you close, right? This will get you in the ballpark. And wow, they're only asking, $150,000 a unit. Everything in the area is selling for $225,000 a unit. Why is that, right? Okay, let's look a little closer. This one's selling for, okay, it's right in line, but maybe there's still some value add or something that I can do here. Maybe, I'm okay with some longer term investment, and I don't need like a quick value add now. So as long as it's in line with the market, then we're good, right? Or maybe like, wow, they're asking, $300,000 a unit, which I think is what Portland is at actually now, on average. But, and everything in the area is, $250. Why are they asking so much more? And asset class, and when you get a multifamily and some of that stuff, definitely plays a part in that. What is it? Is this a class A, luxury, discretionary income property where people are paying more than what they actually need to, like they're staying there because it's a nice place to live, right? Versus is this a class C location and building, workforce housing and things like that, where so you can't just look at that, right? But you have to take those pieces into account for sure, because obviously the higher rent buildings, the higher income tenants, that's going to be a higher price per unit. So, but anyway, it is a starting point, right? It is a starting point. So you're going to look at similar properties in similar areas and see what they're trading for on average. And then this is going to give you a clue. Is this price right? Is it priced too high? Is it priced low? Is there opportunity here, right? So that's a really, really, really easy one. Again, this is very, very high level. It's meant to just be a really quick analysis, just to kind of get you started and say, should I look closer at this? I will say you can miss opportunity if just stopping there. So I would look closer, but there could be ones that are like way outside where it's like you just toss it out because there's no sense. If you can add units, things like that, right? Okay, so next one is your gross rent multiplier or your price per rent ratio. Usually it's called GRM in the commercial multifamily space. You're not calling it price to rent ratio, but people call it that as well. Typically in the residential world more, but easy formula on this one as well. Price divided by your annual gross rents. So it's your annual rents, not your monthly rents. So you're going to take your monthly rents. You're going to figure out what your annual gross rents, meaning before any expenses. What are you supposed to collect, or what are you collecting on an annual basis? And then, so price divided by those annual gross rents. This is another really pretty quick and easy metric, really simple to run that formula. You can run that really, really quick, and you can get a sense of what that gross rent, what the asking price is of a building compared to what the gross, based on the income, right? Versus what they're going for, what other buildings are going for in the area that are similar. So an example on this one, same $2 million 10-unit building, $1,200 a month rents, so your annual income on that is $144,000 on all those units. So you take your $2 million divided by your $144,000 annual gross rents, and you get 13.88 gross rent multiplier. Now, one thing to note on this, so the higher the gross rent multiplier, the more that they're asking for that same income, right? So if they're asking 15 times the gross rents, they're asking 15 times the amount of what they're getting for rent. So, and if they're asking less, then they're asking for less. Let's say they're asking, it's a 10 gross rent multiplier. That means the price is lower compared to the current income. So hopefully that makes sense. So it's an easy thing to look at to say. I was looking at one recently where everything in the area we were comparing to, it was about a 17-ish gross rent multiplier right in there. And there was one offlier that was like a 22 or 23 gross rent multiplier. So they're asking a lot more for the current, based on the current income, for the price, right? So now this was just a duplex, so from a comparable sales standpoint, it was in line with pricing, but based on the income, it was way out of whack, right? So, and then as you get into your commercial multifamily space, hypothetically, it's supposed to be valued on the income. It is valued on the income. We've had a lot more speculation, especially in the last few years, or people willing to pay for what could be and not what is, but it's supposed to be based on, that's why you run these formulas. It should be based on what the income is and not what it could be, right? So one thing to note on this, so like I said, a higher gross rent multiplier means they're asking more for the income. A lower gross rent multiplier means they're asking less for the income. And then, so an example here is like that same $144,000 income. If it was a 12 gross rent multiplier, the value would be 1.7. If it's a 15 gross rent multiplier, the value would be 2.16. So you can see how that affects the value or the asking price based on the gross rent multiplier. And so and what you can do is, if you know what most things are trading for, you can do a quick backwards formula, right? And say, okay, well, they're asking this gross rent but things are trading at this, so what should the value actually be versus, instead of what are they just asking, right? Just like the example I said, a higher than average gross rent multiplier could mean that they're low current rents, but they could be higher current rents, and they're just asking a price based on what market rents are, not what current income is. The big thing on gross rent multiplier is that it does not take into account operations, and it does not take into account expenses, right? This is your gross rents before expenses. So it's, again, another quick metric, but it doesn't tell you anything about how the building is run. It just tells you based on how much is coming in for revenue, but not how much you're actually making on the property, right? So that's what we're going to talk about next, which is cap rate. So this is a little bit more complex one, but when you understand it, it's really important. And it's really important that you do understand it if you're analyzing income property. But to do cap rate, first you have to figure out your net operating income, or your NOI. So what is that? Basically, the formula for net operating income is your gross rents, which we just had, minus your vacancy rate, minus your expenses. So that $144,000 a year gross rents that we had, take out about 5% for vacancy. You want to do, based on your market, obviously, it's about $7,200 a year. Call it a 35% expense ratio, so it's about $50,400, and you're left with $86,400 after vacancy and expenses. Obviously, if you have actual numbers based on tax returns and numbers from operations, you want to use those. But if you're you can use market averages and stuff like that as a starting point. And so that 86,400 is your NOI, your net operating income. So now to get to cap rate, what you do is you take your net operating income and you divide it by the price. Okay, so if you take that $86,400, divide it by 2 million, and you end up with 4.32 or 4.32%. So that is your cap rate. The thing to note on cap rates, and wrap your head around if you're not familiar with cap rates, is that with gross rent multiplier, the higher the gross rent multiplier, the more they're asking for the income. It's actually opposite with cap rates. So the lower the cap rate, the more they're asking for the income. Okay, and the reason why that is because basically a cap rate is your return, your cash on cash return. If you were to pay cash for that building, what would the income be based on your investment? So that's why. So if you're paying a higher price for that same income, your percent return is going to be lower, and vice versa, right? So if you pay less for the building for that same income, your return is going to be higher. So hopefully that makes sense. Example here. So that 86,400 net operating income. If it was a 6 cap, so divided by 0.06, you divide it by. So that's actually 1.43 million. So a huge difference. And then if it's in an area like Seattle or some of these really low cap environments, 3%, 3.5%, that same income, the value would be almost 2.5 million. So the lower the cap, the higher the value of the property. Now again, there areas and asset classes and types of products, all that have different cap rates that they're trading for. So if you know what cap rates are for a specific type of building in a specific area, you can figure out what is it going to be worth if I add value. What is it? Am I buying it at a higher cap rate than market? And then you can figure out, again, value is based on the income and the cap rate and the return, right, that the market is giving. So if you can buy something at a little bit like we just showed there, right, you buy this at a 4.3 cap and the area cap is a 3.5, you've already basically made $400,000, right? And then the other side of that is if you add income, or if you're able to operate it better or increase rents or lower expenses, whatever that looks like, to be able to increase that net operating income, now the value has gone up, right? So you say you add $100 a month of net income per unit on that 10 unit, so that's $12,000 a year in increase to your net operating income. If that 4.32, say you bought it at what the market cap rate was, so it was worth $2 million when you bought it because it was a 4.3 cap, that's a market cap, but you've added this $12,000 a year in income. Now, based on that same cap rate, your new value is basically 2.25. So you've made $250,000. You've increased the value by $250,000 by increasing the income by about $12,000 a year. So very powerful tool in investing. When you start getting into value-based or income-based valuation, income-based assets, you can really affect the value by improving your operations and improving your income. And you can see how that small little $12,000 a year, that's not a lot to write home about in real estate investing, right? There's a lot of ways to make a lot more money than that in real estate. But when you look at what it does to the value, that $12,000 a year of added income gave you an additional $250,000 of net worth on your balance sheet. So Very powerful tool. If you don't just look at the cash flow, look at what it's doing to your net worth, right? And then again, you can run these numbers, these formulas the other way, is to figure out, is someone what is this going to be worth after I do something? What should it be worth based on the current income? Because again, a lot of people, especially in the recent market that we've had, have been asking prices based on what could be and not what actually is. And so you can take, okay, well, they're saying that it's worth this much, but you know, and then and I agree with their cap rate, but their income isn't that. Their income is actually this, and you use their current income and not their, you know, pro forma future could be income, because especially, you know, depending on how low they are, and especially in, you know, states like Oregon where you can't raise rents, or you're limited on how much you can raise rents, it could take you a while to be able to do that, right? And even if you're not, I mean, it takes even if you're not in an environment like that, it's not like you're going to get that right away, right? It takes time to turn over tenant base and increase those rents. Even if you're legally able to do it, it's not like you'd be able to do it day one, right? So you should get the benefit of that entrepreneurship, not the seller. Now, again, it's been a really tight market, so a lot of sellers have gotten it. But the point is, you can take that and say, okay, well, they're basing it on future income, or what the market rents are, but their current rents are this. So I'm going to base the valuation on what current rents are, and you run the numbers that way, and then that'll give you what the value that it is based on the current income, and then you can try to approach the seller with that and say, hey, look, I understand the rents could be this, but they're not, they're this, and so based on what everything else is selling for, I think you're asking for an appropriate, you know, cap rate or gross rent multiplier or whatever metric you're using, but because it's not that income, it's this income, you know, I have to base it on that. And so here's the numbers that I ran. Here's what I'm willing to pay for it. So, so there you go. Those are the quick ones. Price per unit, price per square foot, really quick and easy. Not much to that one, right? That's a good starting point to see if they're even in the ballpark. Gross rent multiplier or price to rent ratio, another pretty quick one to run and just kind of see if they're in line. And that'll tell you a little bit of the story, like that one example that I gave you. That's just like, wow, why is it so high? Probably just because their rents are really, really low. And so that'll give you some quick insights. And then the cap rate and the net operating income and running those numbers, that's going to give you more of an insight of how things are managed and run, and what value is or based on the current income and what it should be, and what you should be paying for based on that income. So if you're not familiar with all those terms, and how those formulas are, get to know them, spend some time running the formulas, look at some properties that have those numbers that you can run them, get to know how to run those formulas quickly. I know it can, especially cap rate. I think people get confused with the whole lower cap rate, higher value thing. So run a bunch of numbers with cap rates until it clicks for you. So that way you can really be effective in running these numbers. And then again, you can run all these formulas fairly quickly. Do a quick analysis on a deal, you know, in 10 minutes. See if it's even something worth digging into more and doing some more due diligence. So again, hopefully that's helpful to you guys. I am still working on building that platform. I keep saying it, and I keep saying it partially to make sure that I'm accountable to myself and putting that out there and getting that platform up. But I really do want to have a place where we can all jump on and have one place to collaborate and meet each other, and you guys can communicate more effectively with me, and I can put some resources and tools and some other great things on there. So I'm looking forward to that. I'm really trying to get to that. As I mentioned, lots of other things going on with brokerage activity and with family and all that stuff. So, but hey, I got to kick myself in the butt here. You know, intent doesn't do anything unless you take action, right? So intent is nothing. Lots of people have good intentions and get nothing done. So that's a message to myself. Anyway, I'm gonna make that happen. So I'm looking forward to doing that. And on that note, if you guys have something, don't leave a real estate or anything else that you have a goal of doing in your life. Don't leave it as an intention. Okay, take it to that next level. What is it going to take to take action on that and take it off the table as just an intention and make it something that's active in your life? So whether that's health, whether that's your spiritual life, whether that's real estate investing, business, relationships, anything. Stop leaving it as an intention. Make it an active part of your life, and just do it. Just make it happen. No more excuses, okay? To myself and to you. Thanks again for listening, guys. Have a great rest of the day. Go out there and make some things happen.